folks, we are going to cover the Commitment of Traders report and COT charts for use in trading the Forex. And we can use this information to track what is referred to as the smart money. Before we get started though, what exactly is a Commitment of Traders report and what's its purpose? Where does it come from? Well, every week the Commodity Futures Trading Commission, CFTC, releases a report basing three groups of traders: the large hedgers, commercials; the small speculators or small traders, retail traders like ourselves; and then the non-commercial large traders. Okay, in these three groups, they report their overall positions. Basically, by breaking that number down, total longs and total shorts, they get a net position for each group. And by tracking this information on a cumulative line basis, like you see here in our depiction, this is a net traders position chart. On this example, the heavy, solid, thick black line represents the commercial traders. The thin, very thin black line is the small specs or retail traders like ourselves. And then there's the large speculators that are a little thicker line. And if you note on the chart, typically the large speculators and the commercial traders are diametrically opposed at extremes. And inside that is a real gem of information that we're going to cover tonight, and a couple other subtle nuances that go along with trading the CFT's Commitment Traders report. Okay, we've already gone over real quick what three groups that the Commitment Traders report covers and documents their positions on. But basically, the one category of traders that you want to be avoiding and not being classified in is the small trader. Okay, because basically this is the uninformed, or what is commonly referred to as street money. And I'm being polite because it's usually referred to as the dumb money. And basically it's the small retail traders. It's the guys and gals that start their accounts up with a very small amount of money with very little training under their belt with trading, and they just get in there and they gamble. That's typically the losing group. If you look at the overall track record on a COT graph, you'll see that 90% of the time they're wrong on the moves, and that's why the statistics are what they are. This is a net sum zero game where there is a winner and a loser, and typically this category is the losers. Tracking the informed money, we can use the non-commercial large speculators group. This is typically the fund traders or institutional traders. By nature, they are trend following, so they will be wrong at tops and they will be wrong at bottoms. And by that, I mean because they're trend following in nature, they allow the market to take them out, and sometimes it requires a lot of movement for them to be bumped out of a uptrend, and vice versa for a downtrend. But they're okay because their long-term perspective is that their trend following nature will get a lot of profits for them, and that's what they're trying to get. They're not trying to pick tops and bottoms. So it is useful for us to understand what this group does in relation to the next group, which is the commercials. Now, how can we track smart money? Well, smart money is the commercial large hedgers. They have real trained accredited staff and are always watching fundamental supply and demand factors going along with any tradable market. Because the CFTC releases this report, it's predominantly commodities, and it's not limited to currency commodities. It's also, like you see here in this report, you got agricultural markets, you have financial markets, and interest rate markets as well, that the CFTC reports their net positions for all three groups. Well, what makes the commercial large hedgers quote unquote smart money? Well, first of all, they have more money than any of us collectively. We're talking about large corporations and banks and you know, corporate entities that have a real reason to be in the market doing business with these commodities, whether it be currencies or agricultural markets. And I'll give you a perfect example, non-related to Forex, but still will suffice with our explanation. If one were interested in trading cocoa, um, that is a soft and it's a tradable commodity, what large commercial trader in the world would have a significant understanding of what the supply and demand factors are for that particular commodity? I think it would be safe to say that Hershey in Pennsylvania in the United States would have a very strong understanding on what the supply and demand factors are for cocoa. So if they're net long on cocoa, I think it's safe to assume that they expect higher prices at some point. And the same thing holds true with currencies. If we see a large net long position held by the commercial large hedgers, they believe that there's a fundamental reason because they trade on fundamentals. They don't trade on technicals, they trade on fundamental supply and demand factors. We as technical traders, we trust their fundamental analysis by seeing their actions in the COT charts. I'm not, as a technical trader, I'm not really interested in what fundamental data are driving the euro up or down. It's too many factors on a daily basis, minute by minute, many times, to keep up with that information. But if I allow my long-term perspective to be based on the fundamental picture that the commercial traders are providing me by their actions in net long or net short positions overall, I filter out all the necessity for fundamental analysis on my own part. And I just allow them who have more trained accredited staff, and they pay people, top dollar to understand and track the day-to-day fundamentals on supply and demand factors. So it stands to reason I don't have to bombard myself with uh, all this chasing of information, where I just allow the chart to tell me what the supply and demand factors are based on what price is doing in relationship to the long-term net long or net short position of this category of trader, the commercials. So it's very important that we understand what they're doing because they are the market. They provide the liquidity for us as retail traders and or eventually large speculators, fund managers, of if you want to call yourself that eventually if you traded to that point. But it is important that we understand what their position is at particular times in the marketplace, and we're going to learn more as we go. One of the most important things as a technical trader that when we use the COT data, there is a extreme importance in understanding where we are in relationship to the commercial net long or net short position over the last 12 months. Whenever the markets reach a particular high, most often you'll see a net long position in the large traders and a net short position in the commercial traders. In other words, there'll be a diametrically opposed tug of war between the two groups. And typically what will happen is the market will top out there. And the large funds will be net long, while the commercials have been calling a significant high in the market by being net short. If we see this relationship take place and the commercials, using this example in front of us, if we look to the left side of the chart where it shows a 12-month extreme net long position, if this was held by the commercial traders, this would indicate a probability of a long-term or significant intermediate term low to be forming in the marketplace. On the right side of this graph, a 12-month extreme net short held by the commercial traders would indicate that there would probably be a long-term or significant intermediate term high to be formed relatively soon after this reading in the COT data. The majority of market tops and bottoms are highlighted by COT fingerprints left by the large commercial traders, so it's very important that we understand where we are in the last 12 months in terms of range. What was the highest reading they had net long? What was the lowest reading they had in net short? And by basing our readings currently between those two parameters, it kind of like acts as an overbought, oversold, and it gives us a more or less a COT index. Are we really oversold or overbought based on their net position or net long or short? And we'll learn more as we go. When we get to 12-month extremes on the net long position, it's very important as technical traders, we have to learn to anticipate a major trend change. Okay, that means typically what you'll see is the market will be trading down in this instance, and the commercial traders will have been calling a low to be formed by continuously buying more than they're shorting, and that would allow the COT report to suggest that it was a significant net long position. So we would be filtering out our short trades when we get to these readings and looking for major trend reversals to go higher. And contrary, whenever we get to a 12-month extreme net short position, that means price would have been rallying up and the commercials would have been selling into that rally, and at some point if they reach a net position extreme of 12 months, this would indicate that we are very close to, if not at, a long-term high in the marketplace. And this is not a, like I said, it's not a timing tool, it's a selection tool. In other words, it gives us a long-term anticipation of something unfolding, and we just wait for technicals to line up with that premise. So again, it's for early warning major trend reversals, and it's based on long-term analysis. You know, you're not going to be day trading on the net long or net short position, but you will use the information to help you with your intermediate term, short term, swing, and day trading. How do commercials trade? I think this is one of the fundamental factors that most individuals that use this graph or report that's released every week, this is more or less how the commercial traders trade. Okay, and it's probably an oversimplification on my part, but hopefully it will convey the process that the commercials trade within. All right, we're going to cover just the accumulation phase because obviously the distribution phase would just simply be an inversion of everything you see here. So a standard commercial accumulation phase would be price would be trading down on your daily chart. So think in terms of this example as a daily chart. So from the left side of the chart, price has dropped down, and they'll be buying as price drops. Okay, so commercial traders are very early in the moves, and they provide the market for us small retailers to speculate in. It's not their job to give us a means to trade in, but it just so happens that they are the ones that facilitate trade. They're the other side of our trade typically. And as markets decline in price, the large commercial traders accumulate large net long positions, all the while prices are making lower lows. When the market reaches a low of some importance, okay, as that market rallies higher, the same large commercial traders distribute that large net long position, and the cycle repeats for the price swing that they're engineering now for a later swing lower. And you see typically over and over again how the commercials will buy into declines and they'll sell into rallies, and they are the entity behind the overall price structure that we trade within. When the market low has been formed, all of their net long position, as now price starts to rally up, they start distributing and they sell each portion of that net long position to now distribute into the new rally. As price goes up, they sell more of it. As price continues higher, they sell more, and they sell more as markets make the high. And what you see in hindsight is this becomes your intermediate or long-term low on your daily chart. So now this information is very valuable because now we are not guessing anymore. We're allowing the market internals and the large commercial traders, they are the ones that are going to facilitate the market move up and down based on this information. So basically, as professional traders, how are we going to use this information to trade with? Well, As the price structure starts to move up, okay, and we're forming an intermediate term or long-term low on a daily chart, as the price rallies up, what we're going to be looking for are 4-hour, 60-minute, and 15-minute basis optimal trade entries to buy on retracements. So as a professional trader, we wait for the low to form in price action. We trade long with the understanding that commercials will be selling the market to us. Okay, we are going to allow price structure to get us in sync. Okay, because they will already have their net long position in place, but they're going to be selling it to us as it unfolds. While that moves up, that's the trend that trades higher, as we'll see later on. And our objective is to make money as it trades higher, buying low, selling high. They have already accumulated a large position, so they're going to be selling and distributing it to us. So we're going to facilitate the other side of the trade. Alright guys, now we're getting to the brass tacks. This is the COT insider tactic. Many times simply because the commitment traders report suggests that we have a net long position by commitment of traders data stating that the commercials are net long. Simply because they're net long doesn't mean it's a time to buy, and vice versa. If it shows that we are reading a commercial net short position, it's simply because they're net short doesn't mean it's time to sell either. Okay, but we're going to look at a stylized depiction of what could be interpreted at any time in the future using this information. All right, example number 1. Okay, what this is going to indicate is a 12-month extreme net long position for the commercials. Okay, and when this happens, you want to reduce the risk on any short positions that you have, or look to close them on any strong drives lower in price. If you get some kind of capitulation or large range moves going down, that's usually the telltale signs that you're near a low in the market. Cover your shorts and start looking for buying opportunities. Example number 2. This is a net short commercial position, and simply you'd be looking for a short to intermediate term downside correction. In other words, after point 1, price will have started to rally. Okay, and they're going to sell into that rally, and at some point they'll be net short. All that's going to do at some point is indicate that we're probably going to see an intermediate term or short term pullback in price going lower, and we can start looking for optimal trade entries to form for swing trades going long. Point number 3 is a net long commercial position, and after 12 months extreme, as we see in point 1, okay, the trend is now engineered by the commercials. So this is the ideal condition to be buying in. Once we move back above the 0 line, which is denoted by this heavy black line in the middle, point 3 is a net long position. This is an outstanding time to be buying a particular market, because now we are in sync with the commercial trend that is being engineered, and you can see on your COT graph and charts. Point number 4 is simply a net short commercial position, and you would just simply look for a short to intermediate term down move or correction in the overall uptrend that would be unfolding since the low that would have formed near price example 1. Point number 5 would be simply a net long commercial position, and you would look for a short intermediate term buy, because now again you're still trading with the trend that's created by the engineering of the commercials at price point 1. So in other words, from point 1 to 5, you had really 2 solid opportunities to get long and be in sync with their long-term trend of the commercials. At price point 6, this would be a 12-month extreme on the net short positions held by the commercial traders, and this is where we would look to see the trend that was created going up and called at price point 1, where the commercials had a net long 12-month extreme. That was the low in the market, You could have bought at price point 3 net long position, and you could have been buying at price point 5. And these typically you'll see daily, 4-hour, 1-hour, and 15-minute optimal trade entries to form to get you in sync with the higher time frame trend engineered by the commercials. We would start to unravel and unwind our long positions if we see an extreme like at point 6 where it is now a 12-month extreme net short position, and we would liquidate our longs and or tighten our stops and allow price to take us out, then look for new buying opportunities. And this is the cycle that goes through with the commercials. This is how they facilitate and engineer market swings and how we can utilize that information and trade on their coattails. This is the concept that no one's teaching and no one talks about, but this is the very thing that you need to be doing. If you're going to be using this information, this is how you use it. You look at the trend that the commercials are engineering and you trade in sync with them based on the extremes. So the inner secret to commitment of traders is to trade with the trend of the commercial traders set in motion at or shortly after fresh 12-month extremes in net positions. This holds even more strength for 4-year commercial net extremes. They are the trendsetters and they propel price. We can only speculate and ride on the waves that they create. All right, let's look at an example here. We have the Euro weekly chart. And if you like these charts, just to be fair, because I am using their service, pricecharts.com is the provider for this. It's relatively inexpensive. I get nothing by telling you this, and you don't need to have this chart to do this. You can get your COT charts from several free services on the internet, and I've already shared them on babypips.com. So if you do some research there, you'll be able to determine where you can get the information from for free. But if you really want crisp, nice charts, this is one place to get them from. Okay, so we can clearly see at the bottom that net sum zero line is 0, and the heavy black line is the commercials, and the smaller in thickness black line. And if you look at the diametrical opposed positions, that's the large speculators or trend following hedge fund managers or non-commercial traders. And in the very thin black line is the retail traders that are pretty much wrong all the time. So if you look at the price swings in the euro, you can see that the commercials pretty much called the highs and lows of every significant price swing. And that's the category of trader that we want to be mimicking, okay, and allow them to engineer the price swings that will unfold, and we trade within that price swing. All right, here we have at this point it was a 12-month extreme on net short position by the commercials, and if you go straight up from that point on your chart, you can see pretty much was the top in the marketplace. The euro made a high very shortly after that and fell off precipitously. Which soon after basically created a extreme net long position, as you can see here. And if you go straight up from that point and you see where price was, it traded down to the 120 figure and made a long-term low and traded off very aggressively. Which was followed by, almost a year later, the low was pointed here is actually a net short position by the commercials, and it was a 12-month extreme. So the 12-month extreme that was created in April-May time period of 2010 we just looked at, making the low at 120 on the euro. Now we have a net short extreme by the commercials, 12-month extreme. So that will break the cycle or buy program that the commercials put in place in 2010. And if you go straight from that point up there, and we failed to make a higher high and more or less made the top in the euro, and we've been trading down since. All right, this right here is a net short position on the commercials, and you can see how that was just a correction from the low made at the 120 figure, coming off of the April-May time period in 2010, where we made a now new buy program for the commercials on a long-term perspective. So now when we see a net short position by them, until we see a net short position 12-month extreme shorts by the commercial, the trend in motion for long-term perspective by the commercials is an uptrend. So in other words, looking for buys. At any time, if the net short position is held by the commercials in this uh, environment, it's mainly just going to be a corrective pullback and just to give another buying opportunity for the long-term trend. All right, let's look at more detailed examples, okay? We have the extreme net long position by the commercials, making the low at 120. Go straight down from where we see the circle, okay, delineating the net long position, 12-month extreme by the commercials. Straight down at 6 o'clock on that would be the diametrically opposed trend following large traders, non-commercial chart large traders. You can see that they were at their heaviest net short at the same time that the market made its low. Okay, so they were net short, you know, for a long period of time. As the commercial traders were buying it up, the trend following were selling into it until we reached a low. The low was formed by the commercials. They put the stop on it, and 120 was the low. What that looked like on your price charts is this is a daily chart, and you can see how the market made a significant bounce. And for those that have been trading using my information and materials and concepts, you can see several optimal trade entries from that point and getting in sync with the long-term trend. And if you go back to the videos on baby pips, you'll see why my trades were so profitable. Another example, okay, this circle delineates another net long position by the commercials in a time period where we have made a 12-month extreme net long position by the commercials in 2010. That buy program is still in effect, and price trades down to the 129 figure area. But look at the weekly chart. That would have been a optimal trade entry, and price really went up from that point on. And you can see that was the daily chart, and you can see the optimal trade entry that would have formed as well, and price really went vertical. So you can see the power of using this information and the trend engineered by the commercials on a long-term basis on where we are in relationship to the last 12 months extreme. This buy program that was set in motion by the banks, this is the reason why we've seen the price catapult and go vertical. And there is your optimal trade entry that would have been retracing to 72 and 79% retracement levels on the daily chart. All right, obviously, we've already covered how it's not simply the commercials net long or net short. Okay, it's just not that easy. Okay, you want to look at the trend set in motion and then engineered by 12-month and or 4-month extremes by the commercials. They are the stopping power and the facilitator of market moves up and down. Okay, they are the ones that put the stops on it. So if they're going to put the brakes on a decline on the market, it's going to stop. It's going to stop going lower, and they will buy up the position, and the market will soon rally. So It's important that you understand that don't be so fixated on whether the commercials are net long and net short. More importantly, where are they in terms of their long-term trend based on noting 12-month extremes and 4-year extremes. And if you look at where we are coming from most recently, is it a 12-month or 4-year extreme net long? Then we're in a buy program. If we're coming from a 12-month or 4-year extreme net short, we're in a sell program. And that is only canceled by a new 12-month or 4-year extreme to the contrary. So now you are empowered to use the COT data. This is an example how you don't simply need the net short or net long position by the commercials. Okay, we had a buy program that began in the spring of 2010, and in the fall, late August into September, we seen that price was still in the buy program. Okay, but they had really increased their net long positions, and that is also an indication of a buy. You don't simply need to have a net long or net short position based on the zero line. If you see a rapid increase of buying and increase of net long positions, and by that I mean how you uh, classify that? What is significant? Well, to me, 15 to 20% increase or decrease on their net positions, and you can get that by raw numbers in the report. That is an indication that for here would be bullish. And if you go straight up from that point in price, that was a significant low because we were in a buy program, remember? And that was the low right here. If you plot your fibs on the daily chart, you'll see that that was at the optimal trade entry as well. All right, so some closing comments and tips for your success when using the COT data. Um, Main thing is you need to stop listening to the herd. Okay, and majority of the forums and message boards that we frequent as traders, because we like to know what other people think about our trades or our perspective, or if you're like me, I like to see what everybody else is thinking, because many times I'm going to be doing the contrary of what they're all talking about. So main thing is this tool will help you avoid listening to the herd. Okay, we've learned that you want to trade in the direction of the most recent 12-month commercial net position. You're going to wait for price to form intermediate term swings. You're going to use optimal trade entry patterns to enter and trade with the large traders. The large traders will be in sync after the move starts. By following them, you will be on the right side of the marketplace. Filter long positions when COT reaches fresh 12-month and or 4-year extremes on the commercial net short position. Filter shorts with COT reaching 12-month and or 4-year extremes on commercial net long positions. Trade with the COT trend engineered by the commercials. Look for seasonal tendencies to line up with net readings for remarkable trade examples like we've talked about here. If you go back at our seasonal tendency charts that we shared on baby pips, and you'll learn more about those seasonal tendencies in subsequent installments. When those factors line up, you have outstanding long-term trade scenarios where you can really capture, 5, 8, 1200 pips, and those are the types of swings that this concept is going to be able to empower you to harvest. You're not going to be looking for 20 pips a day with these types of events. You're going to be looking for significant, several hundred to over 1,000 pip trades, and this is how you get it, guys. If you have more questions about the COT data that I didn't cover here, uh, the two best resources from my library is the Commitments of Traders Bible. I really wish they wouldn't use that term, but that's the title of the book, and it's by Stephen Brees. And then you have one of my favorite mentors, Trade Stocks and Commodities with the Insiders, Secrets of the COT Report by Larry Williams. If you can get anything by Larry Williams in print, get it, read it. There's a lot of stuff that he does talk about that I don't use, but there's a lot of things that he does use and talk about that I do use successfully. So there's some two good recommendations for books for your own library, and you can get these on the internet. They're not expensive, and if you look hard enough, you can get really good deals. Hint, hint, nudge, nudge. All right, guys, if you liked what you've experienced here, obviously you can find me on babypips.com, and we have a thread, and going to be having several threads going into the future. But my name is Michael Huddleston, and I'm referred to as ICT on Baby Pips, and or AKA the Inner Circle Trader. Guys, I wish you good luck and good trading.